Good morning, everyone. Welcome to the new week and the macro snapshot. We are Monday, May the 5th, 2025. Okay, let's just review where we are overall. I just want to have a quick look. I was just looking at a couple of things this morning. Kind of interesting to look at the real yields, which is this white line here. So if we go here and we look at the white line, you can see here that we're still at about 2.01%. So the point is that the real yield is still quite elevated. And I also just want to show just having a look as well at the term premium, which hopefully will come up in a second. You see the term premium is still at about 50 basis points, 51, 52 basis points. So the point is there that the real yields are still elevated. The term premium is relatively elevated. So those yields and that premium is not showing a recession at this point. In order to show a recession, we can assume that in a recession, those yields, that real yield would be much lower, and the term premium would probably come down quite a lot. So just at the moment, it looks as though these two particular sort of metrics, which are pretty important, I would say two things. They're not really reflecting the market thinking that a recession is imminent and is going to be deep. Now, of course, that could change with if real economy data sort of comes in. And secondly, the fact that the real yields are still over 2% and the term premium is still quite high, I think it's going to make it difficult for equities to rally more, because at the end of the day, that's going to be a headwind if the real yields are getting paid over 2%. So that's kind of a bit of a general context. And I think that really points to the fact that where the market is at the moment, the market is nervous. It doesn't really expect equities to rally a huge amount, but there's a lot of uncertainty. On the other hand, all of this talk about recession, but we don't exactly have that at the moment. And if we just look at a couple of charts, it's kind of interesting just to see there's sort of a conjunction of things happening. Let's have a look here. So if we go up to, just want to show you guys. So we see, again, I just want to look at the VIX here. So you look at the volatility. The volatility's obviously come down a lot. And keep in mind that, maybe 40 or 50% of the volume and things like the S&P 500, SPX, a lot of that is sort of algorithmically driven, sort of systematic CTAs, but also vol targeting funds. So it's quite important just where the VIX is. And if this volatility is low, that will give a bit of a headwind to equities. And that's what we've seen, of course, over the last few days. Has been a pretty significant rally. But my point here is that if you look here, this is when Trump announced his tariffs on April the 2nd, and you see the gap higher in volatility. We've now come down to almost sort of fill that gap on the VIX here. And I'm just thinking that, the VIX here, maybe it's going to go down a little bit, 21 and a half, something like that, a little bit more. It looks to have popped this morning. But the point is here is that maybe signaling, some kind of base there for the VIX. And and that ordinarily at that point, if it starts to go up, that could not be great news for the stocks. The second sort of triangulation, the point in the triangle I want to show you is, let's say, for example, just look at the 10-year yield, and you can see that the 10-year yields here have also got up to a point, where, for example, you can see here, this is also, they're getting up to a sort of quite a high point, quite a key level here as well. So I'm trying to make the point here is that up around about 4.34, something like that, is quite a key level here in the yields. And as these yields start to go up and go up higher, and they could, actually push up to 4.4 or even a little bit more. So as they start to push up more and more, you've got a situation where the nominal yields are going higher, real yields remain elevated. The VIX maybe has found its lowest point. And I just think that putting those two together, it's going to make it difficult if those nominal yields here, also the real yields continue to go up and the VIX starts to go up. I'm just then sort of trying to triangulate that here with the ES, and you start to say, this is getting a little bit difficult here. And actually, I'm just going to put on some moving averages here. And you see also here, which I signaled the other day, I think on Friday, is that you now have the confluence of the 200-day and the 100-day moving average. You also have filled in this gap between the Trump tariff announcements on April the 2nd, which was here. You see this one here, this sort of orange box. So, can the equities push higher? For sure, if we get sort of tariff relief and, all kinds of good news. But at this point, we've had a lot of the earnings and they've been pretty solid. Although keep in mind that some of the companies, quite a lot of the companies have deferred giving sort of forward guidance and basically said, it's very, very uncertain. So just interesting that, the equities finding a bit of resistance overnight in the Asian session. As I say, let's keep an eye on those real real yields, the nominal yields, which keep on pushing up, and also the VIX. And I think if the VIX starts to push up higher, that's, combined with those higher nominal yields, that's going to start putting a little bit of pressure on the equity market as well. Sort of grab some tea here. Okay, but that gets us to the point of course, where actually is sort of the real economy. And if we go back and have a look, we had a pretty strong non-farm payrolls on last Friday. Of course, a lot of people are saying, it's looking in the rear vision mirror. It doesn't really tell us that much. And if we actually sort of have a look at it, we can just see that, it was a pretty strong number, higher than expected. It's sort of interesting also just to see where these jobs are going. What you guys can notice here is that the federal government jobs, no surprise, they're starting to go negative. I guess that's a result of some of the firings from the Department of Government Efficiency, Elon Musk, Doge, all that kind of stuff. But you see that the jobs which were added were in healthcare and social assistance, not exactly sort of super high paying jobs. I mean, nonetheless, we did get some jobs there. But you can see here construction is starting to go down a little bit. Manufacturing is actually a little bit negative. Retail is actually a little bit negative. So, fairly solid job number. Um, Average hourly earnings going down, so that's a bit disinflationary. But again, difficult to know if this is just the beginning. This is like the pre-tariff thing. What is actually interesting, just having a look here, I always like to look at the daily shot. Quite an interesting graphic here. This is a small business. So small business in the US, their use of credit cards, and you can see here that this is the average usage and the average payments. So the average usage is on the sort of dark brown line. And what you can see here is that the sort of the spread between the payments is actually sort of going down in a sort of a negative way. So this means that basically there's a widening gap here, and that the payments is sort of less, not as good basically. So, could this sort of signals that there's a bit of credit stress starting to happen in small business? Again, just one small data point there, but definitely there is an interesting sort of sense here that, some of these payments are starting to roll over, and also the usage is going down. So maybe less confidence there, and also less ability to repay. So that's something quite interesting to be looking at here. Okay, so in terms of everything else, let's just see, have a look at where some of the markets are. We had over the weekend the OPEC Plus meeting. So if we actually have a look, let's just look at the oil chart. And basically what OPEC Plus did, quite an interesting dynamic. They agreed, and again, this is pushed mainly by Saudi Arabia, to increase more quickly than had been expected their sort of production. And so if you look at the chart here, the market sort of gapped down at the open about $2 or $3. It subsequently sort of come back a little bit here. But essentially, they decided to put an extra 411,000 barrels per day of extra production. Now, that's actually 3 times what they had signaled. So there's definitely a bit of a ramp up. And there was also discussion that the 2.2 million barrels per day of production, which has been held offline, that could come, all of that, back in a lot more quickly than I think it's the September deadline, September 25. So just sort of forgetting all those little details, essentially what's going on is that the Saudis are annoyed that countries like Iraq and Kazakhstan are sort of producing too much. They're producing more than their quota. So it almost seems as though the Saudis have basically said, fine, we're sick of us, the Saudis, having discipline in terms of our production to try and keep the prices elevated. And so they're almost, I don't want to say a price war, but they're deliberately sort of pushing out a little bit more oil into the market. And they know that's going to push the oil price down, which you can see here. Maybe in an effort to sort of discipline, so to speak, countries like Kazakhstan and Iraq, and also maybe to sort of get a little bit of less production out of the US. Because if we go over to the US here, we can see, what I want to show you guys is the total oil production for the US. You can see that after the COVID period here in 2020, it's the white line here. You can see that oil production in the US seems to have been reaching some kind of a sort of a topping out formation and like a plateau. And you can also see the number of wells. This is the Baker Hughes wells number in the blue here. You can see the number of wells basically maxed out at the end of 2022 here. And the number of wells is sort of going down, or at the most is sort of stable. And maybe what's going on here is that the Saudis are saying, well, hey, we're sick of us, the Saudis pumping less, trying to keep the global price of oil up. And the Americans have been producing quite a lot. But it looks here as though the American production is starting to plateau. And maybe what the Saudis are sensing here is that if they can keep the price lower, let's say sub 55, sub $55 in WTI for, I don't know, 3 or 6 months, that's going to put significant pressure on the American oil producers who might start to cut back their own productions, and the Saudis can then take some of that market share. Keep in mind, at least according to the survey which was put out by the Dallas Fed, who look at a lot of the oil stuff in the US, that the average kind of break even, so profit point, the point at which producers in the US make a profit, is something, depending, but it's kind of like 55, 60, $62. So let's call it around about $60. So as WTI gets below that level, that really starts to put quite a lot of pressure on the US producers. So something going on here, potentially something sort of geopolitical as well. Maybe sort of the Saudis have said to Trump, okay, we'll try and keep the oil price down, which of course Trump promised as an election, one of his election promises. Who knows, maybe there's like sort of defense contracts and other geopolitical things in the background. Just while we're on oil here, let's have a look at the curve. Quite an interesting curve. As I said, normally this is not as aggressive when it comes out. So definitely what we're seeing here is that the outright price has come down quite a lot. We're still in a backwardated state, so there's still sort of physical demand. And again, some people are saying, I was just reading a research note this morning, essentially saying that, we have the upcoming American driving season, which consumes a lot of gasoline and therefore crude oil. And also the temperatures in Saudi are very, very hot seasonally. So the Saudis themselves can actually export less because they're using a lot more sort of crude oil for their own sort of air conditioning units and whatnot. So the point is that the physical demand seems to be relatively robust. The sentiment is quite negative in terms of the global trade situation. But so we have quite a strange curve here that, the front end of the curve is still holding up. It's still in a backwardated state here. But then it's signaling, a little bit of weakness and then suddenly a pickup. So it's almost as though the oil market is trying to say that there's going to be weakness, a little bit into the future, 4, 5, 6 months into the future, but then things will stabilize and improve a little bit. So as I think I said last week, there's quite an unusual shape of the curve here. So I'm just curious, going back to the chart, that if physical demand is still reasonable, and maybe the Saudis are just sort of admonishing their colleagues here, it's going to be interesting to see here what happens. I've put a little forward projection there, but I might actually get rid of that. But you can see here that basically overnight we couldn't quite test this low here of $55.09. It looks like we got down to about 55.30. So that's kind of interesting that the market decided it didn't want to sort of go out there. So let's look at the price action today. Keep an eye on the curve. And I just saw that the Saudis actually raised their official selling price, the OSP, to Asia this morning. So that's signaling sort of maybe this is more directed at US producers trying to put pressure on them, but actually there's physical demand still in the Asian market. So let's keep an eye on this. If this cannot retest lower, maybe this could be interesting moment to sort of think about some kind of call spread structure. So that's something I'll be looking at today and having a little bit of a think about that. So that's that. Other news, just keeping in mind. So let's look at the Fed. So we know that we have the Fed meeting this Wednesday. I'll probably talk more about that tomorrow, but let's just look at some of the pricing. We had on Friday, after the non-farm payrolls, which, as I said, was quite strong, a very aggressive move at the front of the curve. So if we actually look here and look at something like the 2-year, here we go. So this is the ZT on the futures. You can see here that the 2-year actually sold off a lot. Now, I understand that, the data was, relatively strong here, but this is a pretty significant sell-off, not only on Friday here, but also on Thursday. So on Thursday and Friday, we had a very, very big sell-off. And you can see this in the repricing for the Fed. So we had been the market had been pricing in about 4 cuts until the end of the year. So if you just go here, you can see here that the market had been pricing in 4 cuts. But as you can see, I'll just put it actually here. This is on the tick chart. You can see that we were at about 100 basis points of cuts. So you see this down here. And then suddenly on Thursday, but especially after the non-farm payrolls data, you see this here on the Friday morning, you can see that the number of basis points to be cut, you see it's a negative number, went from negative 100, signifying 4 cuts, down to about 80. We got actually to about 75, so about 3 cuts. So the market took out almost a full cut, almost about 25 basis points on Friday. Very, very aggressive. I was a little surprised by that. So we're now at a situation where It's interesting. I mean, I just wonder if this starts to become sort of a potentially a buying opportunity, something I'm going to think about again today. By the end of the year, we've only got just over three cuts left in terms of pricing. And then actually, if you sort of take it out, we can go onto the SOFR curve. You can see the terminal rate here. This is where the SOFR implied yield is only just over about 3.2%. What is that? Let's have a look. 3.15%. So if you consider at the moment that the effective Fed funds rate is at 4.33, let's call it 4.3, and this is down to, let's say, about 3.2, that's only about 110 basis points of cuts for the terminal rate. So not just in 2025, but also 2026. And indeed, if you start looking at that, you go all the way out to for the Fed meetings out to Christmas of 2026. You can see the terminal rate here. As we see, it's about 3.1-ish or something like that. So just about four and a half cuts, something like that, priced in. And you've got to think that that is priced for a pretty strong economy, I would say. That's basically an economy which might have a very soft, bit of softening, but certainly not an economy which is, going into a recession or even a strong recession. The second thing I want to point out, and this is probably a little more general and longer term, is that Trump again over the weekend he released an interview saying that he's going to keep Powell until the end of his term, which is sort of in the spring of 2026. But we can presume that Trump will appoint the new governor of the Fed will be someone who's very dovish. We know that Trump likes lower interest rates, and I would say it's almost certain that he will appoint a Fed chairperson who will be a dove. And therefore, presumably, would be more open to cutting interest rates. So my point here is that the market took out a full 25 basis points on Friday after that non-farm payrolls, and I just wonder if it's starting to look interesting here. If this gets down to, let's say, about three cuts for the December 25 SOFR contracts, maybe long call spreads or something, or maybe even into 26. Something like that could be quite interesting, but definitely having a look at that. And of course, that's going to depend on the data. And we have the Fed on Wednesday. We'll talk about that a little bit later on. In terms of what's going on today, we do have a little bit of survey data. So again, note we have to take this very carefully because note there's been, we saw the non-farm payrolls, which was hard data, was actually showing a pretty solid economy and a solid employment situation, whereas the surveys and the sentiment and the consumer confidence sort of information and surveys has been quite weak. So again, putting that all together, we do have the ISM services today at 10 o'clock in about 2 hours or so. What's interesting again is just to see if the prices paid remain elevated or whether they start to come down a little bit. That's what the Fed wants to see. And that could be a catalyst for the 2-year, the front of the curve, to sort of have a little bit of a bounce. New orders is going to be interesting. New orders is an interesting one because it is a survey, of course, but it is forward looking. So that's always interesting just to see if that where we go with that. And then, of course, employment. And what's going to be interesting is just to see whether the employment index from the ISM services contradicts in any way the NFP from last Friday. And keep in mind, of course, that about 70% approximately of the US economy is in the service sector. So this is very, very important. So let's look at a combination of all of that today and see whether that gives a bit of a boost up to the markets. In terms of other things, apart from the fact that Warren Buffett stepped down over the weekend, let's just look at some other stuff going on over the weekend. In this upcoming week here, we had the Swiss CPI this morning. Now that was actually lower than expected, actually at 0. And so it's possible that Switzerland, the Swiss National Bank, have signaled that they're prepared to go into negative interest rates. So let's keep an eye on the interest rate situation for Switzerland and also on the Swiss franc. Could that start to weaken? I mean, that's an interesting one because the Swiss franc, there's been a lot of safe haven flows. So it's been strengthening. But on the other hand, I think the Swiss National Bank, looking at the inflation situation and the strength of the Swiss franc, they don't want that. They probably want that maybe to be a bit weaker. So let's start looking at some of the cross pairs and whatnot with Switzerland. ISM services we talked about. Now we do have the auction cycle again. We have 3s today, then 10s, then 30s on Thursday after the Fed on Wednesday. interesting again just to see if there's going to be some a strong demand. We saw, or shall I'll talk about this in a second, but we saw that, for example, in Taiwan, the Taiwanese dollar was strengthened enormously over the last 2 or 3 days, especially on Friday. And there's been a lot of chatter, commentators on Twitter saying that the liabilities are mismatched between Taiwanese dollar denominated assets and US dollar denominated assets, and that maybe a lot of the big players in the pension funds in Taiwan are actually having to sell some of their US treasuries to sort of raise US dollars to pay some of these liabilities, and that's called so they're selling the dollars, and yeah, and that's pushing up the Taiwanese dollar. So interesting just to see if that bleeds into the treasury into the auction kind of demand. I don't think so, but that's also something to be looking at. We can keep an eye on China here. We've got the Caixin PMI coming up tonight. Um, Other things which I'd say are quite interesting. Obviously, we've got the Fed. We'll talk about that, but we also have the Canadian jobs market. Or the job numbers coming on Friday. And what's going to be interesting about that, obviously, there's a new prime minister in Canada, Carney, who's trying to sort of negotiate with Trump. And keep in mind that the US dollar has actually weakened against the Canadian dollar. We can start to look at let's just look at the currency trends. We can look at that. So if you look at the Canadian dollar, um, it's actually strengthened quite a lot against the US dollar over the last couple of weeks. But it's going to be interesting to see if with the jobs number for Canada coming up on Friday, whether that's a reminder to the market that the Canadian economy actually is pretty weak, and could that be a little bit of a turn in the US dollar is strengthening a little bit. Just what I want to point out here, guys, just in terms of the trend. What is interesting is that the US dollar continues to be weak overnight. We've seen a lot more weakness. So, the trend is still fairly negative in the US dollar. And basically everything else is up, especially we're starting to see strength in the offshore Chinese renminbi here. You see that the Chinese renminbi, which had been weakening, actually is coming out of that weakening cycle. And over the last, let's say, couple of trading sessions has actually strengthened a lot. And that's strengthening a lot of the Asian currency. So you can see here also the Aussie dollar, which had been weak, is actually now starting to push up. We can see that gold, had a pretty strong session overnight and remains kind of a buy on dip. So just interesting to see what's happening there. You can see also just in the 2 and the 5-day trend here that the US dollar really is is very, very much under pressure. Euro continues to be supported. The Swiss franc, despite the low inflation number, seems to be supported, and some of and also things like the Japanese yen. So if we look at a couple of the charts here, we can see. Let's just have a quick look. Just how much the US dollar is under pressure. So you see that it got up to the 100 mark and is now sort of falling down. And that's just basically this idea that the US economy possibly is weakening. The Trump tariff thing, it doesn't seem to be fully resolved at this point. And there does definitely seem to be a continuing, if not a rotation, maybe just not sort of overseas buyers actually sort of overweighting anymore their holdings of US sort of treasuries or stocks or US denominated assets in general. So as I was saying, you can see here the USD CAD, you see that's starting to push down now, which indicates CAD strength. But again, interesting, as I say, to see on Friday what's happening here. If you look at other pairs, you can see the Aussie dollar here. There was an election in the weekend in Australia, and the centre-left party campaigning a little bit on an anti-Trump rhetoric, got back into power with an increased majority. There's also sort of some sense here following some Trump comments over the weekend that maybe tariffs against China wouldn't be quite as bad. That's doing the Aussie good. So the Aussie pushing out as well. We can see the US dollar falling against the Japanese yen. It looks like at that one of those Fibonacci levels here, it's falling, and we can also see strength a little bit in the euro. So overall, US dollar kind of weakening, and that's interesting just in the context of the yields. As I said, the yields going up. This is an unusual situation historically, and just to have a quick final look at that, if you look at the nominal yields, let's say something like the 10s here, you can see that the 10-year yields are pushing up at the same time that the US dollar is going down. So it does seem here to be a bit of a confidence thing, a bit of a flow thing. Let's keep an eye on that. Apart from that, I think I'll leave it there, guys. So again, today let's keep an eye on the S&P 500, see if that continues to show some weakness or whether that was just like an overnight blip. Very key levels. there. Also want to be looking at the VIX to see if it keeps on pushing down or whether that finds a floor. And, possibly that could be, a function today of what Trump has to say on the tariffs. There's some sort of talk of, announcing trade deals. But my personal view is that a lot of these so-called trade deals will be a little bit cosmetic because the nitty-gritty, the actual detail is going to take several weeks, if not a month or two or three, to actually have a full, like an adult kind of a real kind of agreement. Trump will try and push everything. So we'll see what happens there. And of course, we have the ISM services at 10 o'clock. Okay, I'll leave it there, guys. Let's have a great week and we'll keep the conversation going. Thank you.